A tax credit is the cleanest math in the tax code. It reduces tax liability dollar for dollar, but the exam will immediately split credits into two buckets. Non-refundable credits can only take your tax down to zero. Refundable credits can push past zero and turn into an actual refund. That one difference drives a lot of test questions. Here's the quick mechanic. If you owe $300 of tax and have a $500 non-refundable credit, you only use $300 and the extra $200 disappears. With a refundable credit, you use the $300 and the extra $200 becomes a refund. On the EA exam, they love giving you small liability numbers to see if you know which credits can go beyond zero. Common non-refundable credits include the Lifetime Learning Credit, Savers Credit, Child and Dependent Care Credit, Adoption Credit, the Credit for Other Dependents, and Energy Credits. The American Opportunity Credit and the Child Tax Credit are the weird hybrids. They have non-refundable pieces, but also refundable components under certain rules. When you see those names, your brain should flag. Part refundable, part not. Now the refundable side. Earned income credit is refundable. Additional child tax credit is refundable. Premium tax credit is refundable. And you can also see refundable items like excess Social Security or RRTA withholding. Again, AOTC shows up here too because it's partially refundable. On exam day, if you see EITC or ACTC, you should automatically think refund is possible even with zero tax. Here's the due diligence trap. If you're a paid preparer and you prepare a return claiming EITC, CTC, or ACTC, or AOTC, you have extra requirements. Same idea if you're determining head of household filing status. The tool is Form 8867, the paid preparer's due diligence checklist. On the EA exam, the question is often simply, when is Form 8867 required? Those specific credits are the trigger. One more rule that catches people: TIN timing. For EITC, CTC or ACTC, and AOTC, you can't fix a missing or late issued taxpayer ID number after the fact and still get the credit. If the SSN or other required TIN wasn't issued by the return's due date, including extensions, the credit is blocked. That includes filing an original return late when you should have filed on time. In order for a taxpayer to claim the child tax credit, the child must have an SSN that's valid for employment and issued before what date? Your choices include the child's birth, the due date including extensions, the due date not including extensions, or the end of the tax year. Think about it. The answer is the due date of the return, including extensions. That timing rule is a favorite exam detail. The tempting wrong answer is the end of the tax year, because that's how a lot of eligibility rules work. But for the CTC SSN requirement, the key date is the filing due date, and extensions count. Which of the following will not disqualify a taxpayer from claiming the Lifetime Learning Credit? Options include being claimed as a dependent, having AGI above the limit, filing married filing separately, or having a non-resident alien spouse who elects to be treated as a resident alien for tax purposes. Think about it. The correct answer is the non-resident alien spouse who elects to be treated as a resident alien. That fact alone does not disqualify the Lifetime Learning Credit. A tempting wrong choice is the AGI above the limit option, because it sounds situational, but it's a hard disqualifier. Also remember, being a dependent or filing MFS can knock out education credits.